Chapter 3, Principles of Accounting 1. So in chapters 1 and 2, we've covered some various components of accounting. Now we're going to talk about the rest of the accounting cycle and closing out each time period. In chapter 1, one of the accounting assumptions we look at is the time period assumption. So the time period assumption assumes that accounting transactions can be traced and tracked to a specific time period. That time period can be monthly, quarterly, semi-annually, or annually. Those are the most common time periods that we use in accounting. Next, we're going to look at accrual basis versus cash basis accounting. Under accrual basis accounting, we record revenues when products or services are delivered and record expenses when they are incurred. Under cash basis accounting, information is recorded in the journal only when cash exchange hands. We use accrual basis accounting in this class because accrual basis accounting is legally required by U.S. GAAP. So any company that has to follow U.S. GAAP regulations has to follow U.S. accrual basis accounting. Small businesses or individually owned businesses that don't have to conform to GAAP rules for regulatory and financial statement purposes can use cash basis accounting. We're going to look at a transaction of accrual basis accounting versus cash basis accounting. In accrual basis, we paid $2,400 for 24 months of insurance. This creates an asset for us called prepaid insurance. Each month, we are going to match that insurance expense with the revenues recognized during that period. This is the matching principle required by U.S. GAAP. So each month we would record a $100 insurance expense for the next 24 months. As we record that insurance expense, we would decrease that asset of prepaid insurance. Under cash basis accounting, we would record one journal entry, and that journal entry is only when we paid out the cash. So we would not match our expenses to the revenues of the period. Again, the cash basis violates U.S. GAAP requirements under the matching principles where we match expenses to the revenues earned in that period. Revenue recognition requires that our revenue be recorded when the goods or services are provided to the customer and at an amount expected to be received from the customers. So we've talked about recognizing revenues both in Chapter 1 and Chapter 2. We've also talked about the matching principle. So this is our expense recognition or matching principle that requires that we match expenses to revenues in the same accounting period. Now we're going to talk about adjusting entries. Adjusting entries are entries that are completed at the end of each month before we prepare our financial statements. Our adjusting entries are going to look at transactions that extend over more than one period, such as prepaid insurance. If we pay for a year or two of insurance in advance, that asset benefits more than one accounting period. When we use the adjusting entry process, we're going to determine what the current account balance equals, what the current account balance should equal, and then we'll record an adjusting entry to get from step 1 to step 2. We're going to look at some examples of adjusting entries. One of those examples is in a prepaid or deferred expenses. prepaid expenses create assets that benefit future periods of accounting. Some examples of prepaids are prepaid insurance, prepaid rent, and our office supplies. So when we purchase office supplies, we're going to use those supplies until they run out. It can take more than one period of accounting for those to run out. We have an asset account with an unadjusted balance. We are going to credit the asset account and debit our expense account for whatever we have. So if we have 1 month of insurance, we're going to record an insurance expense and decrease our prepaid insurance, the equivalent of 1 month's insurance. The same with prepaid rent. We will record a rent expense and decrease our prepaid rent count by 1 month. So when we're looking at this adjusting for prepaid insurance, we paid that $2,400 to cover insurance for 24 months. We paid that on December 1st. We record the expenditure as prepaid insurance on December 1st. We debit prepaid insurance for $2,400 and credit cash for $2,400. On December 31st, we are getting ready to close our accounting records for the end of the month or the end of the year. December 31st can be the end of the year for some businesses. Businesses do not have to operate on a calendar year. They can operate on a non-calendar year as long as it makes sense for their business. For example, most schools and government entities run from a year that starts on July 1st and ends on June 30th. So December 31st could just be the end of a month, or it could be the end of the year. Either way, we have to adjust our records for the end of the month accounting. So we're getting ready to adjust our prepaid insurance in step 2. Each month is $100 worth of insurance. So we need to record a $100 insurance expense and reduce our prepaid insurance to show that we have used 1 month of rent. Our insurance expense then is debited $100 and prepaid insurance is credited $100. At the end of our month, when we prepare our financial records, our balance sheet will show that we have 23 months of prepaid insurance remaining, and the income statement will show 1 month of insurance expense. This is how that journal entry looks, where we debit insurance expense and credit prepaid insurance. We would record that every month until the full 24 months have passed. Next, we're going to look at adjusting entries for supplies. So we have information that we purchased $9,720 of supplies during the month of December. On December 31st, we looked at our supply cabinet and we realized that what we have on hand now is equal to $8,670 worth of supplies. So we need to adjust the amount in our supplies account to show what we have used during the month of December. So we're going to adjust our supply account by $1,050 to show that we currently have on hand $8,670 in supplies. And our income statement then will show $1,000 and $1,050 supplies expense, supplies used during the month. So our journal entry will be a debit to supplies expense and a credit to supplies.